Watching shares of Coca-Cola shares edging higher this morning. The food and beverage giant, one Americans know very well in their household cupboards, beat the street's revenue expectations, showing consumers are still buying cans of Coke despite those higher prices. For a deeper dive on Coca-Cola's earnings, we're joined by Gerald Pascarelli, Wedbush Senior Vice President and Equity Research Analyst. Thank you for joining us this morning. So we saw this earnings in line, sales with a beat, driven by those higher prices, but lower volumes in North America. How well is the consumer handling this based on what you're seeing from Coca-Cola?
Thanks very much for having me. When you look at the pricing trends that most of these soda companies have taken over the past 2 years to combat commodity inflation, volumes, have been down in many instances, but they're broadly holding in relatively well. And so, I think the broad expectation is that as these double-digit pricing increases start to, and they're continuing to moderate, but as they come down over the course of 2024 and over the longer term, in theory, that should result in some better volume performance as a driver behind the revenue algorithm.
Gerald, where are you seeing kind of the strongest segment within this portfolio that Coke has that's really helping margins at the end of the day?
Yeah, I mean, they're just getting really strong top line growth in many of their international countries. I think Europe was up 25, up 20% plus, as was Latin America. But even so, like in North America, they're able to still flow through a good amount of pricing, which inherently will benefit their margins. So international tends to outperform on the top line, but with pricing where it is, a lot of this internationally is to combat currency headwinds, but the pricing's still strong. Margins are holding up strong, so it's pretty much broad based.
And speaking of that, because we did see in their report their EPS performance included the impact of a 14-point currency headwind, while comparable EPS performance included an impact of a 13-point currency headwind. Do we expect that to continue as we're sort of seeing what's been happening with at least some of the worst fears about a global recession tempering back?
Yeah, I mean, with Coke, relative to the other large soda manufacturers, they're always going to be more exposed to fluctuations in currency just because about 2/3 of their business is international. The currency impact was admittedly higher than we were expecting. When you look at the movements in spot across key currencies, it's actually become more favorable over the course of 4Q, really through December. And so, headed into this print, we actually thought that their FX outlook, they're currently calling for a 2 to 3 point impact on the top line and a 4 to 5 point impact on the bottom line. We thought that was going to become more favorable, but really what's happening is they have a handful of hyperinflationary markets where they're not able to price through, the currency headwinds, and that's driving the bulk of their current outlook. But if you look at a 4 to 5 on earnings, that will be more favorable than last year. And if there's one thing that Coke has shown historically, it's if you do get meaningful movements in spot, they will revise that line item upwards or downwards depending on which way the spots go. So that will likely change over the course of the year.
Gerald, got to hustle to our finish here, but you were able to listen in on this call as well. Anything in the tone that stuck out to you from the management team at Coke?
I just think they're really confident in their ability to execute. Headed into this print, just based on consolidated volume growth, where Coke has proven that it can consistently grow volumes at a time where volume growth for many competitors has remained elusive. They're getting that, and they expect to continue to get it. And so we had thought that they were best positioned going in, just given the balance of their revenue, to be balanced between volumes and pricing, which they likely get in 2024, and they're always able to generate productivity and operating efficiencies to drive some leverage. So it was a really good guide, coming in above kind of the high end of their long-term, or coming in above their long-term algorithm on both the top and bottom line. And I think the shares are being rewarded as a result.
Gerald Pascarelli, who is the Wedbush Senior Vice President and Equity Research Analyst covering beverages and cannabis. Gerald, thanks so much for taking the time here today.
Thank you.